Welcome in Brian Belski. He's the chief investment strategist at BMO Capital Markets. Brian, what are you listening for then? I mean, if everyone, I'm listening for the inflation stuff.
Well, you just like everybody else. I mean, remember during the climb to 2%, everybody thought we're going to go to 2% and beyond when the momentum was clearly in that direction. But a funny thing happened. Bond yields rolled over. And I think it's one of these stories that people are not paying enough attention to. And we just still think that the Fed's primary concern absolutely positively is COVID-19 coronavirus and in the return to normalcy. And so we would say COVID over employment and employment over inflation. Well, you know, to use the old adage, Goldilocks and the three bears, those are the three bears that I think that they're worried about.
Bear number one, COVID risks. Bear number two, inflation. And bear number three, employment. But I have to stop at this bolded text I see, and I say, this man can't possibly have said this. I must ask him. He said, no signs of wage inflation. You see no signs of real wage inflation out there?
Kelly, if you go back to January, February of 2020, we had a sub 4% unemployment and no real substantive wage inflation. Now, if we do see a federal minimum wage, we actually think that could hurt small businesses and you're going to see unemployment go up. I think no one's talking about that. So I think we're not going to see any kind of consistent wage inflation, Kelly, for several more quarters, if not years. And I think that's the Fed's ammo not to do anything until well into 2022, if not 2023.
Basically, you're saying we were below 4% unemployment in 2020 before the pandemic, and we didn't really have wage inflation then. But it was there. It wasn't like we didn't have it. It just wasn't popping, wasn't accelerating. It was kind of accelerating, right? But now you have such a different labor force. So it's obvious that all of these signing bonus and different things are being used to pull people back in. We're going to have that happen, at least on a fleeting basis.
We are, and it's just like the whole notion of the transitory inflation, Kelly. It's a wonderful point. And as you know, I mean, we're having a hard time finding people to work in the service industry, whether or not it's restaurants, bars, hotels. And so clearly wages are going to have to go up. But again, remember, the biggest part of the wage side of things are those white-collar jobs in the more business jobs. And we have not seen a big an inflationary stance there and trend for a long, long time.
Okay, final question. So we know inflation break-evens, we were talking about this top of the show, they're back at kind of a cycle high, 2.4% this morning. What does that mean for the stock market? What does this whole discussion mean for the stock market, if anything? Does it imply rotation? Are there certain sectors that are problematic, or is it just full speed ahead?
I think it's full speed ahead longer term, Kelly, but I think the next couple of months could be choppy, especially given how strong the market's been. But that's why we've been advocating all year long for equal weighting small, mid, and large in growth and value. Again, as you mentioned earlier, we said that too many investors got out of tech too soon and they missed this trade. Be diversified across sectors, buy the best high quality sectors, buy themes. And remember, the stock market is a market of stocks, and you want to be an active investor in times like these.
You'd be buying Boeing here?
We would be. We own Boeing in a lot of our value and cyclical portfolios, and we love consumer discretionary in financials this year. Over the long term, if anybody wants to listen to a 3 to 5 year call, our favorite sectors are technology, communication services, and consumer discretionary.
Shepard Smith here. Thanks for watching CNBC on YouTube.